Hey everyone, in this video I'm going to do a request from subscriber Abdur Aman. Thank you for your request asking which is a better stock to buy, CrowdStrike or Palo Alto. I hope I said your name right. And here's a video comparing these two cybersecurity stocks and which one I think is the better one to buy now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so to make this comparison, I'm going to look at several critical financial metrics, including revenue, profit margin, cash flow, average diluted shares outstanding, and valuation. But let's start with revenue, and we can see here they've both delivered excellent revenue growth here, with Palo Alto a longer history here, growing from a little less than 500 million in revenue in 2015 all the way up to 7.2 billion, and similar growth from CrowdStrike all the way up to 2.848 billion. The cybersecurity industry is one of my favorite industries to invest in over the next decade. It's got phenomenal growth prospects as cybersecurity is becoming more of a necessity instead of a nice to have, and that's only going to increase as more of our lives change to the digital sphere. So I'm really bullish on the industry overall. The next thing I wanted to look at is these two operating profit margin, and they've both demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you understand what economies in scale are about, you can see Palo Alto has increased its operating profit margin from negative 10% all the way up to positive 8.15% as its revenue has grown. Similarly, CrowdStrike has increased its operating profit margin from negative 50% all the way up to negative 3.27%. I always say I don't mind when companies have negative profit margins so long as they show me that they're improving, they're making progress, which CrowdStrike has demonstrated to be sure. The next metric I want you to consider is cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, The annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand what this is about, look at these phenomenal metrics here. Palo Alto's cash flow from operations to sales over the trailing 12 months at 42.55% positive, and CrowdStrike at 38.37% from the trailing 12 months. And as I showed you earlier, the main reason for the difference between operating profit and cash flow for these two are the significant amount of stock-based compensation that they use. So since they're using significant amounts of stock-based compensation, I wanted to check out how much they're diluting shareholders. And looking at this metric, you can see Palo Alto has increased its shares outstanding from around 240 million up to 349 million, while CrowdStrike has increased its shares outstanding from 170 million up to 243 million. So they're both diluting shareholders significantly using stock-based compensation, which is increasing their cash flow from operations while keeping operating profitability limited and constrained. They're doing this to a similar degree. I can't say one is doing it more than the other. So they've both diluted shareholders, and this is something that investors should keep in mind from these two cybersecurity stocks. Finally, I wanted to compare their valuation, and I chose to use the forward price to earnings ratio. And looking at this metric, CrowdStrike is more expensive at a forward PE of 80.58 compared to Palo Alto Networks trading at a forward PE of 53.65. Now, normally when one company is trading at a significant premium to another company, I require that company to demonstrate to me that they are significantly better than the other company they are selling at a premium valuation against. And in this analysis, I didn't see a clear demonstration of superiority from CrowdStrike against Palo Alto. If we go back and look at the operating profit margin, Palo Alto is better, and Palo Alto is demonstrating increases in this metric similar to CrowdStrike in the last 2-3 years. You can see the trend here. Actually, the slope of growth is better for Palo Alto compared to CrowdStrike. Similar in the cash flow from operations metric, you can see Palo Alto is better than CrowdStrike, and Palo Alto's trend is improving while CrowdStrike is kind of decreasing here in recent months. So given those metrics, I'm not certain that I would be willing to pay. In fact, I would not be willing to pay this premium valuation for CrowdStrike stock. If I was looking at these two stocks, the one I would choose to buy today would be Palo Alto Networks. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.